Good morning, everyone. I would like you to welcome to our session where we will speak about location risk rules. My colleague Steve Norman, who is a senior client technician, will then carry on with the presentation. Firstly, let me run through the agenda. We will cover off these points where we will run through some warm-up questions at the beginning. Then we will look into sources which help us to identify location risk. We will have an insight into European directives that impact on location risk rules. Steve will go through some ECJ cases that basically impacted the location risk rules in general. We will look into countries where the location risk rule doesn't apply and the location of the policyholder is a key factor. Then we will cover some grey areas where it is not that clear what should be the location of risk. Then we will look into local implementation of location risk rules, and finally we will run through some exercises which hopefully give you some more idea about the application of the location risk rules. Then at the end we will have some time for questions and answers session. So the first question, and please use those sheets that you've got in front of you. There are two options, A or B. So the first question is, how many member states there are in the European Union? Is it 27 or 28? Good. I can see that you have a very good knowledge of EU. There are 28 member states. The last member state was Croatia, and they joined the 1st of July last year.
The next question is, how many EU member states apply IPT or associated parafiscal charges to FOS insurance premiums? Fewer than 15 for A, more than 15 for B. What do we reckon? I'm seeing a lot of Bs. That's correct. There are more than 15, we understand.
Yes, correct. Yes. Well, we did a quick count, and when you look into IPT specifically, there are approximately 10 countries which do apply IPT in their national legislation. However, if you look into IPT plus parafiscal charges, you will be looking at more than 15 countries, definitely. So B is the correct answer. Question number 3, which group of these countries doesn't apply IPT? So is it UK, Germany, Hungary, or Slovakia, Czech Republic, and Poland? I can see that questions are getting more difficult. You are giving us correct answers, so yes, that's the B. UK, Germany, and Hungary, they do apply IPT. UK, just a quick overview, 6%, that's the lower rate, 20% higher rate IPT. Germany, in general, 19% IPT rate, and Hungary, two default rates to property and accident policies, 10%, casco policies, 15%. Slovakia, there's parafiscal levy, no IPT. Czech Republic, again, there's also parafiscal charge, but no IPT in place. And Poland, as we did mention at the beginning, there's an ombudsman charge in Poland applied to cost of insurance written in Poland, but no insurance premium tax.
Okay, following on from that one, question 4, who pays the premium tax in Germany? Is it A, the insurance company, or B, the policyholder? It's mostly A and a little bit of B. The insurance company does make the payment as such, however, the person who ultimately pays for it is the policyholder. The cost of the tax is charged back to the policyholder on the premium invoice.
Yes, thank you, Steve. So, to explain the two definitions of who is the payment debtor and tax payment debtor, we would be looking into two different subjects. So if it's a tax payment debtor, that is definitely insurance company, because insurance company collects the tax from policyholder and pays IPT to local tax authorities. However, as a tax debtor, that would be a policyholder who is the insured party or policyholder who pays the IPT with the premium to the insurance company. Question number 5, who bears the cost of the IPT in Hungary? It's a favorite subject of most insurance companies. Correct answer is A, insurance company. Insurance company is basically the entity who is responsible and liable for payment of IPT in Hungary. Policyholder should not pay the IPT, and this IPT should not be invoiced to the policyholder because this is insurer tax.
And the final question, which European country does not follow the location of risk rules? Is it A, France, or B, Switzerland? It's 100% correct with everyone. Switzerland does not follow the standard EU location of risk rules, as Ladislav will explain later on in the presentation.
Thank you, Steve. It looks like that next time we will need to think about more difficult questions because you were correct. Right. Just to sum up, on this map you can see that yes, there are 28 member states. There's a variety of countries, variety of premium taxes. Potentially we are looking at 24 official languages, so this can be seen in most countries like France, Spain, Germany, where local tax authorities do prefer to speak in local language. There are 13 currencies in Europe, in the European Union, so it's local currencies plus euro, and approximately in total there are approximately 90 premium taxes plus fiscal charges applied to FOS insurance premiums written in European Union.
Thank you. For identifying the location of risk on any given insurance policy, we should follow these three sources listed on the screen now. The EU directives, which Ladislav's going to expand upon shortly, prior European Court of Justice judgments that have been issued over the years, and finally individual countries' national legislation, which we again will cover later on. So Ladislav's going to take you through the EU directives first up.
So EU directives, can someone give me a definition of directive? What do you understand under European directive? I can help you. European directive is basically a legal act which European Union gives to member states, and these member states should implement these directives into their national legislation. National legislation and governments are free to choose the way how they apply these rules from directives in their national legislation, but in fact these should be the key points that national legislation and member states of EU should follow. So when we are talking about location of risk rules, we are looking at two important European directives. In addition to these two directives, there's one other directive, first non-life insurance directives, which I can briefly mention. The first non-life insurance directive is important because the Annex A actually defines classes of insurance and describes what should fall under which class of insurance. The second non-life insurance directive is the directive which is focused on the location of risk rules. And then finally, third non-life directive under Article 46 says or speaks about certain rules of the treatment of property, movable property. So first of all, second non-life insurance directive in more detail. So this is a directive from 1988, and the very important article of this directive is Article 2D, which defines the member state where the location of risk is. So there are four intents, and the first one is the focus on the property insurance. Basically it says that if there is a property insurance, the risk is located in the member state where the property is situated. When we are coming to the insurance of any vehicles, in such case we should be looking into location risk which is triggered by the member state in which the vehicle of any type is registered. Again, this is based on EU directive, so the market practice and local legislation could implement these intents in a slightly different way. Let us see the third intent. Covers of holiday and short-term insurance policies, so holiday risks with a duration of less than 4 months. In such case, if there was a holiday or travel policy with a duration of less than 4 months, the location of risk would be situated in the member state in the which was the policy taken out. Finally, the fourth intent, that covers all other insurance types which were not mentioned above. So if there was a policy which didn't cover property, vehicle of any type, or short-term policy which covers holiday or travel risks, in such case, the member state in which the risk is located would be the member state in which the policyholder has his habitual residence or permanent establishment. So, for example, let's look into this example as an example which should follow these four intents. So let's say there's a policy which covers a ship. This ship is registered in the UK. The policyholder is located in Switzerland, and the ship operates between Germany and UK. For this scenario, let's just say that this insurance will be subject to IPT. Could you please answer the question which is mentioned below. What would be the location of risk? What do you think? And again, feel free to use these 4 intents mentioned in the previous slide. So, going from the beginning, letter A, this is not a property insurance, so definitely is not the member state in which the property was situated, because there is no property insurance. There's a ship registered in the UK, so the second intent talks about the member state of the registration. So in this scenario, the member state where the ship is registered is UK, so the location of risk will be triggered in UK. Let's go further. There are no holiday risks, no travel risks, and we insure marine hull insurance class 6. So none of these other intents can be used in fact. However, we are looking into potentially other locations of risks in this scenario, and these could be Switzerland and Germany. Switzerland would be the location of risk in case where the policyholder is located in Switzerland, which means that Switzerland is one of countries, as Steve mentioned before in our quiz questions, which doesn't follow the location of risk rules set by European directives. Finally, Germany could be a location of risk as well, and that would be in case if the ship operated between Germany and UK, and let's say that in this scenario the German legislation required the vessel to be registered in UK. In such case, the vessel would have 2 flags, UK flag because it's registered in UK, and the secondary port of operation would be in Germany, so German IPT could potentially apply as well. Another important directive that describes location of risk rules and its application is the 3rd Non-Life Insurance Directive. This directive specifically looks into the treatment of the movable property, and it says that if the policy covers movable property, the location of risk will be in that country where the movable property is situated. Now, important is to mention that this doesn't cover goods in commercial transit. So if there are goods which could be sometimes seen as a property, but if they are in commercial transit, they will not be treated under this Article 46 of the 3rd Non-Life Insurance Directive. Furthermore, Article 46 mentions that each European member state country has an option to impose tax, local tax, on insurance premiums written on a FOS basis. So it is up to governments, local governments, to impose insurance premium taxes in what way they would like to. Interestingly, not every single European country does have IPT, but most of European countries do apply either IPT or parafiscal charges to certain classes of insurance. Now I will leave Steve to talk about ECJ cases and insight into them.
Thank you. Following on really from the 3rd Non-Life Directive, which gives rise to the right of the member states to impose premium taxes on risks in their territory, there's a case quite some years ago now concerning a policy purchased by Kverna, a UK resident company, covering its global operations. Included in this policy was a Dutch subsidiary company, and the contract stated that the insured could be Kverna itself and any of its subsidiaries. Kverna indirectly invoiced the subsidiary's share, but upon discovery of this policy, the Dutch tax authority billed Kverna for its subsidiary's share of the insurance premium, and the decision was challenged, and the case was eventually referred to the ECJ, who ruled on the 3 questions you see in front of you. Basically, as we've got it all written down, the ECJ backed up the Dutch tax authority's decision, and the case is treated as sort of an example, really, of how a member state can impose premium tax on risks located in their country, and gives them the right to pursue insurance companies for these taxes. Following on to another more recent case is the RVS Levensverzekeringen NV versus Belgium in 2013, which has implications for life assurers more than the sort of non-life insurance that we've discussed so far. So this is more concerning long-term insurance, where a policyholder has taken out a policy, in this case in the Netherlands, and relocated to Belgium. Now, the Netherlands does not impose any premium taxes on life assurance of this type. However, Belgium imposes a 1.1% premium tax. Therefore, when the the case was referred to the ECJ to sort of decide whether Belgian tax was due when the policy had incepted in the Netherlands. The ECJ ruled that the member state of commitment at the time of each premium payment should be considered as the location of risk for a long-term insurance policy. Therefore, life assurers have to take into consideration the cost of monitoring policyholders' locations over the course of a long-term contract, ensure they're registered to pay premium taxes in any given location where they might arise, and the associated administration costs has to be considered when writing these policies. I'm going to hand you back to Ladislav now to discuss location of risk versus location of policyholder.
Thank you, Steve. So we had a quiz question where we discussed that Switzerland is one of the countries where the location of risk rules do not apply. There is also one other territory or one other country where these location risk rules do not apply in general, and that is Liechtenstein. So let's cover off Switzerland first. Switzerland is a country where the key point to determine the location of risk is the location of the policyholder. That means that if the policyholder is located in Switzerland, then the Swiss stamp duty would be due. Said that, we could have various scenarios. We could have a scenario where there's a Swiss policyholder and Swiss insurer. What do you think, who would be liable for the Swiss stamp duty? Would it be Swiss policyholder or Swiss insurance company? The correct answer is Swiss insurance company, because in this case, yes, the Swiss policyholder does trigger the location risk in Switzerland, but if the relationship is with the Swiss insurance company, domestic insurance company, it will be domestic insurance company liable to collect the Swiss stamp duty and pay it over to Swiss stamp duty authorities. Then we could have another scenario where there was, let's say, a relationship between Swiss policyholder and non-Swiss insurance company. So what do you think, who would be liable for Swiss stamp duty in this scenario? Swiss policyholder or non-Swiss insurance company? The correct answer is the Swiss policyholder, because as soon as the relationship is between FOS insurance company and Swiss policyholder, Swiss stamp duty is due to be paid from the Swiss policyholder. So actually the Swiss policyholder should fill in the form 12, and pay the IPT, in this case stamp duty. Finally, we could have a scenario where, and this is one of possible scenarios, where there is a Swiss insured and the insurance relationship is with Swiss or non-Swiss insurance company. What do you think? Would there be a Swiss stamp duty due on this policy contract? Correct answer is no, because we are looking at Swiss insured, not Swiss policyholder. So no Swiss stamp duty would be due on Swiss insured party. Let's say, for example, if there was a French policyholder and the policy covers branches, and one of these branches, let's say for liability insurance, is located in Switzerland, so there's a Swiss insured, there is no Swiss stamp duty to be paid on this element because insured is located in Switzerland, but not the policyholder. So there could be some tricky scenarios to be looked at in terms of identifying of the location of the risk. The next country where the location of risk doesn't apply is Liechtenstein. We need to be careful with Liechtenstein because in general it doesn't apply. Liechtenstein should follow the Swiss stamp duty legislation. However, in scenario where the Swiss stamp duty legislation doesn't apply, then we would follow the location risk rules. So we could come across a situation where, for example, you or an insurance company covers a property situated in Liechtenstein, but the policyholder is not non-Swiss entity or non-Swiss policyholder. In such case, obviously Swiss stamp duty doesn't apply because there's no Swiss policyholder, but property is still situated in Liechtenstein, and the Liechtenstein stamp duty legislation explains that if the Swiss stamp duty doesn't apply, then Liechtenstein stamp duty could apply under certain circumstances. So in this scenario, the property insurance would attract Liechtenstein stamp duty of the same rate of 5%, and insurance company would be liable for the payment of stamp duty. It doesn't really matter if it's an FOS insurance company or domestic, Swiss stamp duty would be paid by insurance company. Now we will go through the grey areas related to location of risk, and I will let Steve to cover grey areas related to vehicles of any kind.
Thank you. Relating to vehicles of any kind as set out in the second non-life directive, the second indent thereof. So you see various definitions on the screen of what a vehicle could entail. So according to the Oxford English Dictionary, a thing used for transporting people or goods on land, example car, truck or cart. In industry practice, this is generally taken to include ships as well as aircraft and land vehicles. And in some countries, there is in the national legislation some definition of this. For example, here you can see Denmark, Greece and Slovenia would regard a vehicle of any kind as a means of transportation. As we referred to in the UK before, includes motor vehicles, ships, yachts and aircraft. In the German legislation, it's not actually strictly defined. The EU Commission, as we stated before, states that it's land vehicles only. And it just goes to kind of illustrate that as you write a policy across the EU, or a series of policies across the EU, the definition of what you're actually insuring could change, and therefore this can influence in tax terms the rate of IPT that could be due in any given territory. And final point here about oil rigs, which are regarded as ships in the UK, as they are offshore installations designed to be moved from place to place. So, just to sum up, there's no EU case law that provides any sort of statute for the determination of the location of risk with a vehicle. EU Commission's view conflicts with a lot of the national legislation, and the tax authorities haven't really issued much in the way of guidance on this. I'm going to pass you back to Ladislav now for a further grey area.
The other important part where there could be a grey area is the fourth intent of the Article 2D of the second non-life insurance directive, which says that the location risk could be triggered in the member state where there is a permanent establishment of the policyholder. Now, it seems to be a very easy question what we understand under permanent establishment, but national legislation and tax authorities' view could be very different. So in general, we can say that establishment could include the head office, location of branches, parent company, subsidiary, or other affiliates, other factories, offices, and so on. But again, it's important to mention that IPT is a national tax. So national legislation can describe these permanent establishments in a different way. So tax authorities may have a different view.
May I ask?
Yes?
Have you seen any connection of the interpretation of permanent establishment ratio to tax treaties, where there is an actual definition of that?
Yes.
Different tax, of course.
Yes.
Have you seen like that?
Personally, I haven't come across any example where we would be looking into tax treaties, but it is possible that tax treaties would differ between establishment located in a certain country and country abroad. So it is possible that in such case you will need to look into definition of an area of permanent establishment for certain policy. But in practice, personally, I haven't come across a situation where we would look into tax treaties for IPT. Do you have any more questions? If not, then I'll leave Steve to carry on.
Yeah, just a brief point as well about French overseas territories accounting for 4.1% of the population of the French Republic. So some of these risks that you could have a risk in the middle of the Pacific Ocean on an island, and the location of risk would be considered France. As you can see, some of these islands mentioned here. So they're split into overseas departments and regions and overseas collectives. And for an overseas department and region, the location of risk is considered to be France, as these territories are part of France. Any IPT due can be filed under the IPT return, and these include French Guiana, Guadeloupe, Martinique, Mayotte, and Réunion. And the IPT rate can be divided by 2 for Guyana and Mayotte on any class of business. There is a discount available on IPT in those territories. The location of risk is not considered France in the overseas collectives, including French Polynesia, Wallis-et-Futuna, Saint Martin, Saint Barthélemy, Saint Pierre et Miquelon, and New Caledonia. However, as I've put at the bottom there, the Wallis-et-Futuna and Saint Martin are tiny little islands with very small populations. They haven't implemented a tax regime, they don't have a tax office, and they are referenced in the French insurance code, so it may be possible to include them on the French IP return, depending on your interpretation of it. And now going to talk a little bit more about local implementation of location of risk rules.
So as IPTs and national tax, we can see a different implementation of Article 2D and those 4 intents from Article 2D of the second non-life insurance directive. One of very good examples is Germany, where in this particular case, Germany follows quite nicely European directive, and as you can see, there are 4 intents in the national German IPT legislation, which covers property insurance, vehicles of any type, holiday or travel risk with a duration of less than 4 months, and finally all other insurance types where we are looking at the location of the policyholder or permanent establishment of the policyholder in case of other insurance types. So we can say that Germany tried to implement all 4 intents in the same way, and they structured the IPT legislation in the same way as the European Directive and Article 2D.
And in Malta, they make reference to what defines a risk located in Malta in the legislation. You can see here, duties chargeable on policies relating to risks referred to in the definition of the term at risk situated in Malta. For point B, vehicles registered in Malta, so that implies that the location of the vehicle at any given time isn't necessarily, doesn't necessarily determine location of risk, and it could be the case that the vehicle is registered in Malta and therefore Maltese stamp duty should be payable on an insurance contract. And in point D there, you can see where the policyholder has his habitual residence in Malta, or where the policyholder is a legal person if the establishment to which the contract relates is situated in Malta. So once again, it comes down to the sort of registration of a person almost as to where the location of risk arises according to the Maltese legislation.
The next country we picked up was UK, and UK is one of a few or little countries where location of risk is very nicely described and detailed. So just for example, the second intent, letter B, relates to vehicles of any type, and you can see that UK IPT legislation nicely describes that vehicles of any type do cover motor vehicles, ships, yachts and aircraft. In some countries like Malta, we are missing this definition, and in such case, it is very difficult sometimes to identify the proper location of risk of a policy which covers ships or aircraft, so for example. The letter D covers other types of insurance which were not mentioned in other 3 intents. So in this case, UK legislation is again very specific, and it says if the policyholder was located or was habitually residing in the UK when the contract was or when the contract is entered into, then the location of risk would be in UK. In terms of business, it would be again the permanent establishment of the policyholder which the policyholder relates to. Now, let's run through some exercises, and I would like you to again use your paddle boards and show us the answers. Feel free to guess, there won't be any punishment. So, exercise number 1. Let's say there's a container ship located or registered in Germany. It is insured for marine hull risks, so it is class 6, and the ship is ship's owner is a UK-based company. So, what do you think? Is the insurance premium subject to German IPT or UK IPT? I see a lot of A's. The correct answer is A. As the ship is registered in UK, we would follow the second intent in the German legislation, which says for risks related to vehicles of any type registered within the application of this act, the location of risk would be Germany. So correct answer is A.
Thank you. Mr. X, whose principal place of residence is in the UK, purchases a holiday chalet in the French Alps and takes out an insurance policy to insure the chalet and its contents. Firstly, what is the class of insurance? Class 9 or Class 13, A or B? See that? That is Class 9, other damage to property. And which country has the jurisdiction to apply tax on the insurance premium? Is it the UK, A, or B, France? Yeah, that's 100% right again. As per the first indent of the second non-life directive, the location of the establishment is in France.
Next exercise, let's say there's an insurance taken out by Mr. and Mrs. Y, who are habitual resident in Ireland. They belatedly purchased a travel insurance during their holiday in Germany, and the insurance is taken out with UK-based insurance company. So the policy covers their German holiday and travel plans for the next 12 months, and the question is again, what do you think, where is the location of risk? Is it Ireland or Germany? I see A, that's the correct answer. It is in Ireland. We need to consider a few aspects, and that is that first one is that it is a travel policy. However, it does cover a policy with a duration for more than 4 months. So we will not follow the third intent of the location risk rules under Article 2D, but we would follow the fourth intent, so the habitual residence of the policyholder, which is in Ireland. So A is the correct answer.
Thank you. And the fourth question, a haulage company based in Belgium pays a premium to cover the loss or damage to goods that it is transporting to a customer located in the Netherlands. So which would be the location of risk? A, Belgium, or B, Netherlands? In this instance, yes, I think mostly A's there. This would be, the location of risk would be Belgium, due to the fourth indent of the second non-life directive showing the establishment.
Correct, yes. Just one more interesting point in this exercise is that in this case the policyholder is Belgium-based company, so the location of risk is triggered in Belgium. What do you think, what would happen if the policyholder was the customer in the Netherlands? So it is exactly the same policy, but it is the Dutch entity who is insured or the policyholder. Do you think the location of risk would be in Belgium, or would it be different and would it be in the Netherlands? Correct answer is B in this case, because the policyholder is based in the Netherlands with a permanent establishment in the Netherlands. We would follow the fourth intent of the Article 2D, which means that the location of risk will be in the Netherlands. So in this case, it will be exempt from IPT. Exercise number 5, and I would like to stress that this is very difficult exercise. I think the most difficult from what we had. So there's a parent company established in France, and this company pays a premium to cover the damage to its subsidiary's premises situated in the City of London. The subsidiary carries out business activities in Germany and Spain. And again, be careful with the answer. Where is the location of risk? Germany or Spain? This is a very tricky question. Correct, that is correct, yes, so you have been paying attention. So the location risk is in the UK because the premises are the properties situated in the City of London, so none of these answers are correct, it is UK. So good, I'm very pleased that you answered most of these questions correctly. Do you have any questions on us? Any points that you would like to discuss? How much time we have, Olivia? 5 minutes? 10 minutes. So if you have any questions, then feel free to ask. If not, maybe we could run through some scenarios and I could ask you questions again. So let's say, for example, there's an insurance which covers carrier's liability. The policyholder is an Austrian entity, and the goods are carried from Austria to Germany. What do you think, what country would be the location risk, Austria or Germany? So we need to identify firstly what's the type of insurance. It is carrier's liability, so this liability insurance relates to a carrier which is who is established in with permanent establishment in Austria. So we are insuring interest of that carrier. So potentially the location risk is in Austria. Then we need to consider where are these goods transported. But in fact, it doesn't really matter because we are still insuring the liability of the carrier. So even if it's an international carrier's liability, the location of risk would be in Austria and Austrian IPT would be applied. If this policy covered goods in transit, and again the policyholder would be Austrian entity, and these goods are transported from Austria to Germany. What do you think? What would be the location risk? Would it be Austria or would it be Germany? Again, it is the same example, the same scenario where the location risk is triggered by the permanent establishment of the policyholder, so it would be in Austria. However, in this case, it would be treated as exempt policy from IPT because it covers goods in transit international.
A question?
Yes?
Are there many rules defining what are goods in transit and when they are considered as a property?
That's a very good question. And not all countries, not all tax legislations do define when is the goods in transit understood or defined as a goods transported, because in some countries, and good example is France, in some countries like France, if goods are in storage for more than 60 days, these goods would be treated as a property. So instead of applying IPT rate, you would apply IPT plus CAT-NAT, IPT, MRPF and other parafiscals due on the property policy. So to answer your question, not every single country do differ between goods in transit and goods in stay. A good example would be Hungary, where they apply default IPT rate of 10% to goods in transit, and if there was a goods in stay, I'm not aware of any definition how many days these goods would need to be in stay. To give you more examples, Belgium would be another case where goods in transit in general attract 1.4% IPT rate. However, if these goods were stored in containers, and let's say the containers were stored for more than 48 hours, the IPT rate would be different because it's storage, and the INAMI, which is applied to fire risks, would be applied to this policy as well. And if it's a policy stored or goods stored in containers for more than 48 hours, again, you need to consider a certain percentage of INAMI, which means that you apply 10% share of INAMI rate to the premium. So it can be clearly defined in some legislations, but some tax authorities didn't think about these questions, and there's no clear guidance or no clear definition of what is goods in stay, goods in storage. Any more questions? If not, I would like to thank you for your attention